Hi, I'm Adam,
This is Kevin.
and we are Tech Guys Who Invest. This is the place for business people and investors to learn all about investing. We offer a fresh perspective on what it's like to have a day job while investing, and we share lessons learned on our investing journey. Our vision is to educate and entertain you while adding tons of value to your daily commute. Welcome to our show. This episode of Tech Guys Who Invest is brought to you by Dreamstone Investments. Dreamstone is a multifamily real estate operator based in Atlanta, Georgia, and Tampa, Florida. Dreamstone specializes in finding and acquiring off-market value-add deals across the southeastern part of the U.S. Dreamstone creates immense value by ensuring the tenants are treated like residents and by adding the Dreamstone touch to each of our communities. To schedule a call to find out more about their current offerings and to see how you can partner with them, please send an email to info@dreamstoneinvest.com. You can also check out their website at dreamstoneinvest.com.
Welcome, everybody, to another episode of the Tech Guys Who Invest podcast, where you learn how to invest wisely and safely. Because the show is called Tech Guys Who Invest, one thing or a few things that Adam and I have in common are that we're both tech guys, right? At different jobs in tech, but we still both work in tech. We both invest, although separate, with Adam in multifamily and me in mortgages. And there's another thing that we have in common, and that is we do not contribute to our company's 401k. And Adam, I know that your company has a match for the 401k. Can you help the listeners understand why you don't contribute to your 401k, even with that quote unquote free money?
Yeah, Kevin, that is a question that I thought about, and after doing a lot of research and discovery on the true benefits of 401k and investing in 401k, even with the match, I decided to stop because I found out overall I could do much better just by investing in real estate than I could by putting my money into the 401k. So that's kind of the bottom line. But there's some details in there. Why would you do that? Like, how does that work? How could it not be better when your employer is matching you dollar for dollar? It sounds like free money, right? It sounds great. But in actuality, that money's not given to us. It's added to our account, right? And our 401k account, it's under the management control, the 401k management company. And that becomes assets under management. Those matching funds are now subject to all the fees that the management company extracts from you. Those fees add up to a lot higher than you would think. And over the course of 30 years or so, they take away pretty dramatically from what you would be able to earn on that money. So that's what I started to learn. And the more I looked into this and more I was able to verify this, the more I realized, wow, on that alone, I could beat the heck out of it with my real estate investments. So why would I keep contributing? Then, Kevin, there are other things as well. So staying on the fee topic for a minute, the benefits of compounding are greatly reduced because the fees, the fees charged by these companies reduce our rate of compounding by the fee amount. So for example, let's say that all the fees add up to 2.5%. And it'd be tough to even calculate that because so many of them are hidden. You and I have talked about this before, where it's difficult to discover what the fees even are. Let's just say they add up to 2.5%. That may not seem like a lot, but subtract that from the rate that's compounding over 30 years. That's a lot of money. I mean, you could go from like a, 8.5% rate down to like, 5.5%, 6%. And that's huge. We haven't even started talking about taxes yet. So
Absolutely.
With taxes, you get a lot of people think, well, you get benefits from investing in 401k because you can sort of defer your taxes, or if it's a Roth, you pay them going in. But with the 401k, that comes at the expense of you not having control over your money, right? You are not able to get that money back out until you retire. Furthermore, those tax benefits they talk about are not nearly as good as they seem. Basically, unless you retain, Tom Wheelwright says this, Robert Kiyosaki's tax guy. He says, unless you plan on retiring poor, making a lot less money than you did while you were working, inflation will put you into a higher tax bracket than when you retire. And you're going to pay taxes based on that rate.
Mm-hmm. Yeah. There's a lot of facts out there. One thing is trying to trudge through the marketing that we've been subjected to. And we're not trying to sound like we're putting tinfoil hats on, but the reality of it is that the 401k has evolved into a way to keep Wall Street's pockets lined. In fact, there's an article which we'll put in the show notes where the father of the 401k, he regrets what he created because it opened the door for Wall Street to create even greater profits for them. I would recommend looking up into the history of the 401k and how it's evolved. And it's pretty eye-opening. One thing that I don't like is they tell you that it's your money, but it's really not your money. And that to me is what's frustrating. And what I mean by that, here's a real world experience. When I was at my first job with Oracle, they gave a 401k. They had company match also. And I always taught, max out your 401k, get that company match. That's free money. And that's kind of the only means of retirement you'll ever need. Well, that's a lie. In my opinion, I don't think that that's the best way to figure out how to retire. And when I left that company to go to another company, I was planning to use that 401k as a down payment for a property. I would love to house hack, and I could have used that money if I was still working at Oracle. So I had called my Fidelity rep and said, hey, this is what I want to do. And said, hey, unfortunately, you don't work for the company anymore. So you can't do anything with that money. You can't contribute. You can't withdraw it, or you can't take out a loan. I mean, the only things you can do would be either to roll it over, let it sit there, or withdraw it and take that early prepayment penalty, or whatever it is, not a prepayment, the early withdrawal penalty. So I was like, wait, what do you mean? Like, I've spent my hard-earned money and contributed to that so that I could do whatever I want. But it's almost like putting your money into a cage where they're actively trying to get you to keep that money into it. You can roll it over into other 401ks when you get to new companies where they offer it, but the same holds true. You won't be able to do much with it unless you take on that early withdrawal fee. Additionally, one thing you could do, and this is what I did, is when I got to another company, I decided to roll my existing 401k into a self-directed IRA. And because luckily I did it all Roth, I didn't have to pay any of that, any taxes when I rolled it over, except for the free money with the matching. I had to pay the taxes on the free money, which was like, what? I thought this is free money. Yeah. It wasn't. So it kind of sucked, but it's what it is. I took that money and then invested in notes with my self-directed IRA. And I personally, with my investor identity, I like that there's more control. I can pick whatever I want to invest in, whether that's gold, promissory notes, financing people who are flipping luxury watches, stuff like that. I can do whatever I want within the confines of a self-directed IRA. And I love that. It's just more my investor identity to be able to be more active with it. And if you're listening to this and you think, well, I really don't want to take my money out of the 401k, understand that it's kind of a big transformation, if you will, financially. What I do highly, highly encourage is to do the research. Spend the time speaking to whoever your custodian is. Find out what those fees really are. And then if you are invested in a particular fund, research that fund. What are they invested in? Who are the fund managers? What's their track record like? Don't just foolishly select a target date fund like I did and say, well, I plan to retire this year. I'm just going to go with it. That's probably what I recommend. Because even if you decide to invest with real estate, you want to invest with Adam or I, we would encourage you to ask the tough questions to the operator you're working with. What's your track record like? What's your experience? What happens if this goes wrong? How will I get paid? And the operator should be forthcoming with all those answers. And good luck getting all that information from, those big time custodians. I don't know if they would really give you that time of the day. And if I'm wrong, please, I'd love to hear your experience. If it doesn't match ours, we'd love to hear about how it's different.
Now, a reason why you're not wrong, Kevin, and what you mentioned about them having your money in a cage until you retire is because the financial industry has been designed to keep your money. So those wealthy top players in the financial industry, like the hedge fund managers, the asset managers, those guys, they are using our money to generate real wealth, right?
Right.
I mean, they're generating that wealth off of the fees, off of other investments they're making with the money and things like that. So they've designed this system to keep our money into it and make it difficult for us to get out. And then it's pitched to us as, well, this is a way that you can grow your money and retire. So in my opinion, it's a big lie. And a couple of resources that I would encourage our listeners to check out are Killing Sacred Cows, which is a book by Garrett Gunderson, I believe, and I'll put that in the show notes just to make sure it's accurate. And Andy Tanner's 401 Chaos. Those are great to do a little research and start to peel back what really goes on behind that curtain. It's scary.
Yeah, it sounds like we should probably do like a book review, Adam. I think that would be cool for if we did Killing Sacred Cows or 401 Chaos or both, right? But we want to bring you as much information as possible. That's part of learning how to invest wisely and safely. And yes, there's an active component behind it, even if you want to be a passive investor. Let's say you want to be passive partner in a multifamily syndication, or you wanted to partner up with somebody doing notes. The active component is you do the research on the person you're working with, right? And if you would do that with the person you're working with, why shouldn't you do that with your 401k, which is what they claim is supposed to be for your retirement, right? You should apply those same principles to that and really get as educated and informed as possible. And that's another frustration of mine is it's never broken down into simple terms that people can understand. The information, it just, and that bothers me because it's almost like you aren't actively trying to educate me. It's just, I'm going to spew all these terms and these acronyms and all this lingo and good luck. And yes, we have the internet. Yes, we can find that information out. But it gets overwhelming when you see all of these things. What is this fee? What is this percentage? I have no idea what this is. It just makes it extremely difficult to understand. And then you kind of just sit there, analysis paralysis, and say, forget it. I'm just going to leave my money here and hope for the best. Don't do that. Because that's no better than gambling, right? You're just sitting there hoping.
Yeah, exactly. Good points, Kevin. And I've also heard from multiple people who said their financial advisor really tried to discourage them from moving their money into a self-directed. They hadn't heard of that, don't even know what it is, and wanted them to keep their money where it is. Well, of course they do, right?
Right.
They are getting incented on assets under management. And if you move your money and you take control of your money, then they don't get paid as much. So they are going to try to keep your money in the system as well.
Yeah, I agree with you. And one thing that I would say that the 401k could be useful for is building discipline. If you can't save to invest, like let's say you were trying to build up enough money to buy your first rental property. If you can't manage to do that in a 401k, then the chances are it's going to be equally as difficult for you to build up that discipline to do it outside of a 401k. The automatic withdrawal does make it easier, and I would give it that, where you kind of build up that discipline where it just automatically gets put away, and it's less impulsive in the aspect that you can't take it out without a penalty. Whereas if you had the money in the savings and you could just be like, I have $15,000. I'm going to go spend it on something, right? With the 401k, it's more of a process. And then you have to take on a penalty of 10%. I think that's the last time I heard of it. And that is to the advantage. It kind of helps you put that money away somewhere. So let's say you have a 401k and you don't plan to work at this company you're at infinitely. You have a plan to leave in 2 years or whatever. When you get that next job, you could take that 401k money, turn that into a self-directed IRA, and then invest in whatever, whether it's notes, multifamily. So that could be part of your strategy. What I think what we're trying to really convey to you is the 401k isn't what it's chalked up to be. And we implore you to do as much research on your own. It's really eye-opening, and be more, try and take control of whatever you can, whether that's learning more about what we're telling you, looking into the fees of your 401k, looking into what the fund you have is invested in. All of those things are going to be what is important. What we hope you take away from this episode.
Well, that's well said, Kevin. And if you have more questions or want to talk to us more about this, me and Kevin love talking to our listeners, and we love helping people out. We're not financial advisors, so we won't give you financial advice, but we will give you some ideas to check out. We could potentially connect you with people in our network and give you some resources to go look at. So reach out to us if you'd like, techguyswhoinvest@gmail.com. We'd love to hear from you.
Thanks, everybody.
That's it for this episode of Tech Guys Who Invest. This is Adam.
This is Kevin. Thank you so much for listening to this week's episode. Be sure to subscribe to the podcast for the latest episode updates and to receive additional investor insights to help you invest wisely and safely. You can join the TGWI Insiders community at tgwipodcast.com/subscribe. Lastly, we would love to connect with you. The best way to reach us is by sending us an email at techguyswhoinvest@gmail.com. Thanks, everybody.